Let's look at the data. Welcome to the Explainer, where today we're going to cut right through all the market noise and build an actionable map of the entire financial universe. We're going to track the institutional flows from the huge global players all the way down to how it affects your wallet. This is about finding the signal in the static.
Look, every single day, you are getting blasted with a fire hose of financial info. It's this never-ending stream of news, alerts, and hot takes, and it's all engineered to do one thing: grab your attention and make you react emotionally. This is the noise machine, and it's specifically designed to keep you from seeing what's really going on with the institutional money.
You see headlines like this, right? Just constantly questioning the absolute limits of meme coins, feeding directly into that hope and, of course, that FOMO.
And then you get these alerts, a little peek behind the curtain at so-called unusual options activity. Now, this data hints at where the big players, the smart money, might be placing their bets. It's a really important data point, for sure, but it's still just one piece of a much larger puzzle.
And of course, there are the sweeping predictions about huge macro trends that seem to offer this perfectly clear path forward. But here's the thing, here's the divergence that we have to pay attention to. All this daily noise, it's designed to distract. It's meant to mask the real, underlying institutional flows, and that's where we need to put our focus.
So let's just move beyond the headlines for a minute and really analyze the architects of the system. These are the massive, slow-moving engines that set the fundamental conditions for the entire market. We're talking about central banks and treasury departments. These institutions, they aren't reacting to daily chatter. No way. They are shaping economic currents that last for decades through monetary policy, interest rates, and liquidity. Their data, that's the signal, not the noise.
Now, what's so critical to understand here is just how clear their mission is. The Bank of Canada, just like its peers, has one primary job: control inflation. And this isn't some friendly suggestion. It is their core function. Their actions become predictable once you understand their goals. And you know what? Predictability creates opportunity.
And this quote right here, it illustrates the point perfectly. The ECB's chief economist isn't talking about stock picks. He's focused on inflation deviations. So when these institutions signal they're going to hike or cut rates, they are fundamentally changing the cost of capital, how much it costs to borrow money for the entire global economy. It's the tide that lifts or sinks all the ships. And this is where it all hits home. That high-level policy translates directly into this kind of real-world dilemma. A 13% car loan doesn't just appear out of nowhere. Nope. It's a direct consequence of the interest rate environment set by those architects. Their decisions literally create the financial landscape that you have to navigate every day. So, given this landscape, two really dominant philosophies have emerged for how regular people can build wealth. Understanding these two paths is absolutely crucial if you want to align yourself with the market structure instead of constantly fighting against it. So on one side, you've got the simple path. This is a strategy that's all about long-term accumulation, kind of mirroring a passive institutional approach. And on the other side, you have the active path, which tries to capitalize on short-term volatility and market anomalies, often by tracking those very same institutional flows. The simple path is all about two things: discipline and time. It's a strategy of buying the entire market through low-cost index funds like VTSAX and just holding. The goal isn't to beat the market. The goal is to become the market and capture all of its long-term growth. The active path, though, that's all about reading the tape. It involves digging into complex data sets, like the options chain, trying to spot those divergences where smart money might be getting ready for a big move. It's a game of probabilities, risk management, and cashing in on that short-term volatility. And here, this is the result of years of discipline on that simple path. Just look at this breakdown from someone in the FIRE community. The vast majority of their net worth, we're talking over 2/3, is in retirement assets, just steadily compounding over time. This is long-term accumulation in action.
Okay, now, layered on top of these more traditional paths, a new, super volatile frontier has emerged, and it's bringing both unprecedented opportunity and, you guessed it, significant structural risk.
Digital assets like Bitcoin, they represent a real structural shift. I mean, its design as a scarce asset with a totally fixed supply has driven it to these incredible highs, attracting massive interest from both institutions and retail investors.
But
All that potential comes with this coiled spring of volatility. A nearly $3,000 swing in a single 24-hour period, that's not an anomaly. It's a feature of this asset class. And that's where risk management becomes absolutely everything. And this frontier has its villains, or heroes, depending on your perspective. Activist short sellers like Hindenburg Research don't just bet against companies. They publish these incredibly detailed reports arguing their case. They're a structural reality of the modern market that creates extreme volatility and, for a prepared trader, potential opportunity on both the long and the short side. Okay, so with this whole map of the landscape, from the architects to the active traders to these crazy new frontiers, how in the world do you chart your own course? Well, the critical point here isn't about finding some single secret answer. It's about building a personal framework that's based on the data and your own unique situation. Your timeline, that defines your strategy. Your risk tolerance, that defines your tactics. And your personal goal, your definition of enough, that defines your finish line. You have to answer these 3 questions honestly. And when you do, you'll have your compass. But remember this one last piece of data. This game is just as much psychological as it is financial. As this user shows, one of the biggest risks that no one ever talks about is moving the goalposts. Defining your finish line is one thing, but actually recognizing that you've crossed it, well, that's another challenge entirely. All right, just remember, all of this analysis is for educational purposes. The data we're looking at is just a snapshot in time, and the market can and will change rapidly. This is not financial advice. You have to do your own due diligence. Stay disciplined. Stay liquid. We are tracking these flows in real time, so while you analyze the next move, check out the tools in the description. You can sign up for Public and get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis.